Welcome to Value Investing Webinars. Today we are going to talk about value traps. Value investing is all about finding a bargain, and stocks are at a bargain price for a real reason. And how to differentiate between something which is out of favor and though out of favor for a reason but can make a comeback, or it is for a reason and that those reasons will continue and you will hold that stock, you will get a bargain opportunity and it will remain a bargain opportunity forever. That is value trap. To gain insight on this subject, I have with me Nilesh Shetty from Quantum Mutual Fund. He's the co-fund manager at the two equity fund which follow the value investing principles in managing them. I have a set of questions for him. So welcome, Nilesh.
Thank you so much.
Thank you for being here. And this is a very interesting area. You know, many investors will be familiar with the term value trap, but they may understand it differently. What is a value trap according to you?
Now, the key question that investors need to ask whenever a stock price falls or stocks that they believe are cheap is, why is it cheap? What is the reason that is making this stock cheap? The whole market can see that price. So why is it that nobody wants to buy this company? A major reason why companies remain cheap is there has been a disruption in their business. So a company which has had a certain earnings potential no longer has that earning potential. But so essentially a major difference between a cheap stock and a value stock is a lack of catalyst. A company without any catalyst will continue to remain cheap for a long time, but a company with a catalyst, even though it's cheap now, will have an unlocking of value because the earnings in the future will be a lot higher than where it is today. So if the investor can answer that key question, that what is the reason this stock is cheap, and identify the catalyst that will take the earnings higher, that is where they can differentiate between a value stock and a cheap stock.
Okay. Can you recall any pick where you got it wrong? Something which turned out to be a value trap?
Yeah, so of course, I think Subbu mentioned in one of his talk over here, there was an IT company which we owned, which we thought was available at a decent discount to the earnings potential of that company. That company was actually doing really well. Of course, then it was a pre-Lehman era and the company went on an acquisition spree, taking on a lot of debt because capital was cheap at that point in time. Pre-Lehman it did not matter because cost of capital was cheap and there was easy availability of liquidity. Once the cycle turned and cost of capital went through the roof, the earnings potential of a lot of these acquisitions that the company thought suddenly collapsed, and the value of these companies that it acquired was a lot lower. Plus, it had to service its debt in a high interest rate environment, and of course, there was a lot of value that got destroyed in the process. So we kept on meeting the management all the time and rechecking our assumptions. The company would give us a plan saying, this is how we are going to turn around the business, and of course based on the plan we would do our numbers and it would still suggest there is some value left in the business compared to the price that it was quoting at. But given the environment that it was in, it was difficult for this company to undo the damage that was happening on the balance sheet of the company. It was not the P&L that was the problem, but the high debt on the balance sheet was creating problems, given that a lot of the earnings that this company was generating was just going in repaying interest costs. So there was no bringing down of leverage on the books. So we held it for a long time. I think we sold it eventually at a large loss to our original cost of acquisition. But in this case, the fact that we waited for so long and our assumptions, even though what we had did not materialize, and we just kept on giving time to the management, is what destroyed value. And sometimes you have to be dispassionate about investments, and if you see the original thesis being destroyed and the management gives you a new thesis, maybe sometimes you have to be a lot more skeptical about that thesis to come through.
On hindsight, do you think you could devise any parameter which should be non-negotiable, or any metrics which you can follow, which will eliminate this possibility or reduce the possibility of such things happening?
Again, a lot of it was hindsight. Had that company,
of course, it's all hindsight.
Company sort of played out with the plan, it would have looked very different. But the key thing that perhaps one of our big learnings is, whatever original thesis that you have bought the company for, as long as that thesis holds valid, you continue to stay with that investment and you see the earnings come through. If that thesis is no longer valid, then perhaps and then you're trying to hold on to the company based on some new thesis. Perhaps in that environment, then there's a high likelihood that it's going to become a value trap. So as long as you stick to the original thesis of why you bought the company, and that thesis continues to play out, maybe 6 months later or 12 months later, timelines could be elongated, that's fine. But you stick to the thesis that you thought this company, the reason why you bought into this company. As long as that thesis is not disturbed, you can continue to hold on. It does not become a value trap. But once that thesis is disrupted and a new thesis comes through, then perhaps you need to exit that company.
As a follower of something which is embedded in your company, and all the funds, in fact both funds now got reclassified as value funds, and it was already a stated thing in our offer document. Do you have any kind of checklist to spot these things, or simply you have built that experience to spot those companies that okay, they look value and they have? Do you have any checklist?
No,
as part of your framework.
The key question that we continue to ask is any company, once it's sort of available at a deep discount, is why is this company at a deep discount? Majority of the times the answer that we've got is just the difference in time horizons. We are in a world where the market is focused on short-term events. So a company which comes out with a statement saying that my next 2 quarters is bad or next 3 quarters is bad, a lot of the investors just don't want to own those stocks, and they just start hammering it. Well, when we are forecasting companies over the next 5 years, we say, okay, next 1 year is bad. What happens in year 2? What happens in year 3? Once we look at valuations in year 3 and year 4, the company starts looking at deep discount given the hammering that it has got in the market. That is where we, at least as a fund, have got most of the opportunities of stocks that we bought into. But the key point is that earnings 3 years later has to be a lot higher than where it is today, assuming the earnings are falling in the near term. If that catalyst is not there, then that continues.
Catalyst for the earnings.
For the earnings.
The markets might ignore it for a while.
They might, and usually they do. It takes a while for them to realize what has happened, given that they're far too focused in the near term, and they will be skeptical about sort of recovery in the near term. But as long as the earnings sort of 3 years out or 4 years out look a lot higher than where they are today, and the market is not pricing it, the market is pricing something else, where the market is saying this company is doomed now, it's going to remain where it is over the next 5 years. That is where the disconnect happens, and that most of the opportunities that we've got in the fund have been primarily through that. A massive disconnect between near-term expectations and longer-term earnings of the company.
Any specific sector or market segment which you think is they crop up more often, or or something which you think that they look like one, but it is avoidable? Anything that which is any generic view which you are able to form, or it's always bottom up? They are all individual specific stories.
Yeah, we try to avoid taking a sector call. It sort of clouds your judgment. But
anywhere where you find great opportunity which has to be rejected, do you find such?
Yeah, so I'll give you a real example of what happened in the fund. 4 years ago, there was a large power equipment company, a virtual monopoly in its space. The valuation started coming down rapidly. You looked at any metric compared to its histories, price to earnings, price to book, it was actually available at a discount to book. That it suggested it was a deep value stock. But the key point that had happened in that company's history was it was a virtual monopoly, and the structure had changed. Because power capacity was growing rapidly, that company had become a bottleneck in India's growth for setting up power capacity. So the government decided we are going to open up the sector to more players. There was a rush of new capacity by private players. At the same time, because this company was not able to service a lot of orders, the Chinese had come in a big way, and they had 30% market share in the equipment business. So you had massive amount of supply coming up. At the same time, the large private sector players, and we could see that on the demand side, were getting into balance sheet problems, and most of these players are now part of NCLT. So you don't see any new capacity coming from private players in the power equipment market. So the supply had sort of tripled or gone up by 4 times, and the demand had just collapsed. So this company, whatever environment that was operating in throughout its history, that environment was no longer valid in the future. It was an open market, and you see that a lot of companies who are monopolies, when it open up, what suggests it's a value stock is actually a value trap, because they never face competition in their life, and in the future the valuation metrics what they were in the history will not hold in the future,
will not come back.
So even though it was a deep value stock, or optically it looked like a deep value stock, we decided not to buy that company in the portfolio.
The world has changed.
Yeah, and 3 years later, that company is now 30% lower than where it was three years ago. So that is a way for us to avoid that at value shock, because the structure under which this company was operating had changed dramatically.
When a stock doesn't perform for a while, or for a long time, do you have any hard limit? Do you have a time frame of your patience? To put it briefly,
Yeah. So again, the key question is the research has to keep going back and rechecking their assumptions. What is it that they are missing? Why is it that when they thought earnings is supposed to go at a certain level,
assuming earnings goes up, everything is happening, maybe sometime plus minus 20%, because finally assumptions are assumptions, and it reality may not match assumptions precisely. But assuming everything is working fine, but the stock just fails to move, stops moving, and you are waiting and waiting and waiting, and it has been an opportunity loss. Nothing happens to the stock.
Right. No, so in that scenario, if the research is playing out correctly, then we'll just wait and wait and wait, because that cheap stock, whenever we bought into, is becoming cheaper and cheaper by the day. We might even add or increase weight in that position because it's becoming a lot cheaper, and research is supporting in terms of our thesis. And
you will not think in terms of market triggers are also important, or why is it not finding a place, or why it is not getting spotted by the market as a...
Yes, so the research has to tell us, are we missing something in the research? If the research is telling us, no, you're not missing anything, the earnings of this company is playing out as we expected, then we continue to hold it, and we might even increase position if our sense is it is becoming cheaper compared to where we bought it.
So, thank you very much for all your insights. And we have a lot of our website visitors, people who registered, and they have posted questions for you and on this subject. Amir has this question: as a value investor, how should one react to negative news in the media about a company CEO?
Yes, so there have been recent instances of company CEOs getting into trouble. Yes. The key question is, you have to look at the behavior of the board. What is the board up to? You've had instances where the boards, even without doing inquiry, have given clean chits. That time you should be really worried. Then then there's a systemic problem with the company where the CEO is not accountable to the board, or the board is not looking after minority share interests. But if the board is active and there's been an independent inquiry and they've given them a clean chit, so there might be some top level
being followed.
Yeah, and there might be some churn at the top in the environment that you are in. But as long as the board is active and vigilant, then as an investor you should be a lot more relaxed.
But that could be the case of a professionally managed company where the board. But think of a promoter-led company, where the owner himself and the board could be completely, despite having the presence of an independent board members, it could still be held hostage to the promoter's whims.
No, so then you need to be careful while investing in such companies.
That's a big corporate governance flag.
That is a big cop, because then just you don't know what else is happening underneath, not just the CEO level. What are the various checks and balances throughout the company and whether they are being followed. Then as an investor you need to be careful.
Naveen has this question, which is a very basic, first question which everybody: how important are current revenues and cash flows to value business? Will you, in your value, just something which crossed my mind, will you have a situation that no cash flow? Do you ever look at asset plays without revenues and cash flows, but asset plays as an opportunity?
It's very rare where you get companies at discount to liquidation value without any earnings potential. What we do have it is, say, in sectors like cement, where because near term you are going to a cyclical slowdown, they start trading at discount to replacement, and that is where we buy it in the hope that whenever the cycle turns, they will start again trading at a premium and they will start making those cash flows. But eventually that earnings potential has to take the value back to the full value of the asset. Otherwise, unless you're waiting for the company to be liquidated and unlocking value through there.
And liquidation could be a cumbersome time.
And there could be a lot of other creditors and debtors who have a stake in it. But by and large, in commodities, you do get, even in oil marketing companies, in 2016 when we bought them into the portfolio, most of them were available at 50% discount to replacement. But the thesis that we had then was that, again, these are far too important companies for the government not to allow them to make a decent amount of return, because they have to reinvest. They have to reinvest in distribution network, reinvest in acquiring assets. So that was the thesis under which we bought. The assumption is that at some point earnings has to come back.
No, so getting back to his question, how important are current revenues and cash flow to value business?
Yeah, so when Ben Graham laid out his framework for value investing, he said each company's valuation can be broken up in two parts. One is the value that the current revenues and current profits justify, and the value that future earnings and future revenues justify. The greater the part that current revenues and current profits justify, the lesser the risk for the investor, because potential is potential. You can do all sorts of assumptions, and so as a value investor, the current earnings and current revenues in your numbers that you forecast and the valuation that you give for the company, if they play a major role, you have a much larger margin of safety, and that is what we follow when we look at. So you don't want to price in 25-30% CAGR earnings growth, and then that forms 80% of the valuation of the company, and very high. A lot of the time, most of these companies tend to go awry somewhere, and their competition comes in. Those margins are not sustainable, and major destruction of portfolios happen under that scenario. As long as current revenues, current profits justify a major part of your valuation, this is the profit of this company. This is, I think, this profitability, this is the kind of valuation this company deserves, and if it grows at this rate, a conservative assumption, this is, I think, what the potential incremental valuation that can come to. Then you have a very decent amount of margin of safety there.
Dhananjay has this question: how should I invest the idle money which I am waiting for to reach at the right buying price? Further, how can I assess the management quality of a company? Maybe you can answer, how can I assess the management quality of a company? And all I have to tell him that while waiting for a stock to arrive at a price when you will buy, do nothing. Put that money in a liquid fund, have that money handy, and wait for your opportunity. While you're waiting, you're waiting for that, as a prey to come your way. Don't do anything.
Yeah. So on management quality, one is, of course, you can go through the annual reports, look at related party transactions, look at what are the other undiversified businesses the company is getting into, and just the history of the company in terms of how they behaved at different points in time. We actually look at how the companies have behaved in downturns quite seriously, because companies in upturns, it's very easy to run business. In downturns, you come to know who's a management who's sort of in the works and doing what is required in a bad environment. A lot of times there are softer issues when you go and meet managements. What are the things they're telling you in the meetings? So management's talking about how satisfied their employees are, what are they doing for the environment, what are they doing in the society. So we like such kind of managements more. A management which has sort of a TV news channel blaring share prices all the time, looking and telling and asking us why my market cap is not going up and stuff. That is not the kind of management, or you'd be worried about investing in such managements. So again, a lot of these are soft issues, but if you want like a pure simple test, you look at the behavior of managements in downturns, in terms of how they've maneuvered their businesses in downturns, and study related party transactions, and just look at the history of the management, how they behaved at different points in time.
This question comes from Babu. Should I hold a stock if it has fallen 10% from its buying price? And also, how can one decide whether a stock has reached its bottom?
Yeah, so bottom, unfortunately, no one knows. Nobody will know when the bottom is. But what you need to do is, anytime there's been a big sharp share price fall, you need to recheck your assumptions of the companies and what is the reason that you bought into this company, and whether those assumptions still hold valid. If those assumptions have changed, you want to redo your numbers and check what is the new valuation of the company. But as long as the assumption holds, the fall in the price might actually be an opportunity for you to add into these stocks. So the process that we follow at Quantum is, anytime the share price has fallen by 20%, portfolio managers will go and meet the company, and we'll recheck our assumptions. If the assumptions hold, then we might even add more into the company. So as long as the assumptions hold, you don't have anything to worry about. But if the assumptions have changed, you might want to redo and recheck what is the reason, or whether the upside still holds in those companies.
A very different question which I got here is that Manu is asking, how does a stock split impact the value of the stock? Is there a way to evaluate the probability of a stock split? It's just an accounting entry, so you can explain it in greater detail.
Stock split is nothing but just a notional book value. At the most, because sometimes share prices trade at very high valuation, it improves liquidity because the notional value of the stock is now a little less.
That just reminds me, what's the stock price of MRF?
Yeah, it is.
And they have done no split. But the value of the company doesn't change. This is something just for the market.
Yeah, it is. So apart from just some impact on...
What's the case of liquidity in MRF? What's the stock price?
It's a few thousand rupees, I don't know.
Many thousand rupees.
So, but an investor, if he wants to buy a 10 rupee stock versus a 20,000 rupee stock, I think they will be worried. It just notional doesn't mean anything, but it just splitting sometimes reduces that nominal value, so you have some improved liquidity.
So it doesn't matter. Don't wait. And is there a way to evaluate the probability of stock split? It doesn't matter. Don't bother. And I don't think we can guess that. Supriyo is asking that should we focus only on past growth rates and avoid the speculative aspect while estimating the future growth rate, ascribed value. So how much is this estimated future earnings and the real past earnings which have been earned by the company and is reflective in the price?
Yeah, so a lot of the businesses are purely cyclical in nature. So they go through their cycle. So the past growth rates will hold valid as long as there's not been a dramatic change in the macro environment of the country in which they are operating.
Country or the sector.
So you can look at sort of historical growth rates and forecast future growth rates for a company as long as the long-term GDPs are on the same trajectory. What happens is in nascent industries or company industries which are evolving, near-term growth rates are very, very high, and it is unlikely they will continue forever. So also the stage at which the industry is
the land grabbing phase of an industry.
Or
somebody who is okay.
Or even the IT the tech boom that we had. So when they were early,
the land grabbing phase of that industry. Or we can say that the land grabbing phase of the e-commerce business. People are paying any kind of money, of course, in the private domain, for somebody who is able to demonstrate that he has captured a market.
But once sort of the industry is slightly mature, it is unreasonable to assume that industry will grow at a rate above the long-term GDP growth rate or the GDP growth rate that you're seeing right now. So I find it very difficult when I see estimates of companies growing at 2x, 3x sort of nominal GDP growth rate for next decade or 2 decades. It's unlikely. Most businesses, if they're earning supernormal profits, competition will come in and chip away at their margins and bring down their growth rates. So in a sort of cyclical business, you can use a historical growth rate. In a nascent business, you will have to moderate your long-term growth rates given that the business starts maturing over a period of time.
Sunil is asking, given today's tax scenario, which is good investment option? Equity stocks, equity mutual funds, or hybrid funds? I don't think you have to really worry about it. The tax treatment of all this is the same. In fact, compared to stocks, the mutual funds route is little tax, but it still has a tax advantage. Of course, the long-term capital gains and short-term capital gains applicable on equity as well as equity fund is the same. But there is a hidden advantage of mutual fund, which is the short-term capital gains, which is generated by the fund manager, is not liable to tax. And if you hold a mutual fund for 1 year, all your gains becomes taxable at 10% long-term rates. So, but this is a marginal difference. The short-term capital gains tax rate is 15% and the long-term is 10%. So you have the 5% differential on the short-term capital gains generated in a mutual fund. I think more important question is that which of the 3 vehicles should you go for and which is more appropriate? First-time investor, go for a balanced fund. If you don't have the time and inclination and a small investor, 10, 20, 50,000 rupees to be invested over a period of time, which is the ideal way of investing in the market for any common individual. The convenience of SIP, go for a mutual fund, go for an all equity fund. You're not a first time investor, you are comfortable with the ups and downs. If you have the time, inclination, and you enjoy this discovery process, this learning process, and you think you have the temperament, these are very big things. Looks easy because buying stock and building a portfolio is just not about your ability to open a brokerage account and buy something. If you have the time, inclination, temperament, and wherewithal to have temperament, meaning the patience, the ability to and keep learning, knowing things. If you're curious about these things, then by all means go and build your stock portfolio. So different things for different people. India, this question comes from Ranjit and it is for you. In India, is India becoming a matured market? And does it make sense to buy value fund for next 5 to 10 years in the current scenario?
Yeah, I think if you look at our per capita income, we are sort of very close to sub-Saharan Africa. So it's unlikely we are a mature market. I think India has a very long headway. Our sense is...
Yeah, so the definition of maturity is dependent on if we are going to achieve, become a developed country, where things have grown to a point where we will achieve, where we need to grow at a far slower pace to sustain ourselves, is what you are referring to as mature. Maybe his understanding of mature market is that there are enough players, there is disintermediation, the scale of businesses, or diversity of businesses in India, number of players. Maybe he's referring to market maturity.
Yeah. So unless
the underlying businesses are evolved. So
no, but again, my sense is, again, if you look at penetration across categories in any of the business,
including market ownership,
including ownership of stocks, right?
Of stocks,
apart from last 3 years, ownership of stocks was very low in India. So
even now,
so it's unbelievable, or very, at least for us, it's not unlikely that a lot of these businesses will not be growing in sort of double digits or low teen double digits in nominal terms, and it's just purely on that, the delta that you'll get in revenues and earnings over the next 15-20 years is fairly high. So it's unlikely to, or it's tough to believe that India is a mature market. I think there's a very long headway. The second part of the question, in terms of does value make sense?
Value is the way to go.
Yeah. So again, if that philosophy appeals to you, where a fund manager would like to buy it at a discount, and then try to limit downside risk in the portfolio, then that style is for you. There are managers who are very good at sort of buying companies who are going at 25-30%. Some of them will not do well, and some of them will sort of collapse on the way. But a value side essentially is a person who's sort of looking at downside risk and trying to protect the portfolio in downside. Not
looking at not losing first, then actually. But that doesn't necessarily mean, because we actually look at it. I would like you to explain this particular dimension. That value doesn't necessarily mean zero growth.
Yes, that is correct.
You are basically looking at companies which are relatively, as compared to your impression of or your estimate of the worth of the company, is available at a discount.
Right. That is
they are not necessarily companies which have been spotted that they are not exclusive of growth. Those companies will be growing too.
But the only difference is the companies that the growth fund is holding is a lot more exciting kind of growth. So we are a lot more boring.
So these companies, by the very design, they may not be very fast growth companies.
Correct. That is correct.
But that doesn't necessarily mean that they are no growth companies or zero growth companies, and that is what is their likability.
But so in terms of, we followed a value strategy, generated a certain long-term track record. It's on par with some of the best funds in India. So it doesn't mean value style will not work. But there are certain phases where the markets will not reward a value style. Last 3 years has been not that good for us, because it's a lot of liquidity has come into the market, and the quality of earnings and balance sheet and downside risk is not something people are worried about. So there will be phases where it will do well.
I will get on to one question which pertains to this particular subject, the discussion. How can I arrive at a margin of safety? Do you have a formula?
Again, there is no sort of set rule. The best thing that sort of you can do is look at the current earnings of the company. Try and benchmark it with its own history and relative benchmarking. Some assumptions you'll have to do, and what is it that the current earnings should get for this company, and then assume a certain amount of growth for this company and a conservative number, and then arrive at a valuation for that company. The greater part the current earnings have over future earnings, the greater the probability of you going or lesser the probability of you going wrong in your assumptions. The greater the potential earnings in the valuation metrics, the higher the probability of you might be going wrong. So that is how simply you are valuing a company. The other metric that you can always have is in say commodities and cyclicals, where if you can get them at replacement to discount value, and you'll usually get them when times are bad, not necessarily when the earning cycle is booming. That time you have to believe in the cyclicality of the business and not worry about sort of these companies making perpetual losses. Just stick to companies who have great balance sheet and who can survive that downturn. And once the cycle turns, you will make a great sort of return once the cycle turns. But that will give you a sense of margin of safety, given that you bought it at a discount to replacement cost of these companies.
Thank you, Nilesh Shetty, for sharing all your insights with our viewers and visitors at Value Research Online. Thank you very much.
Thank you so much.